I was informed that we had 112 teams submit two-page executive summaries, or up to 2 pages of executive summaries in the business plan competition. And as we speak, my assistant, Sam Altman, is vetting them, checking them out, and sending them out to the judges. It'll be scoring them over the next about 12 days, and then we'll notify everybody on the date that's indicated in the rules. I think it's about 10 or 12 days from now, who those teams are that advance to the semifinals. But the next thing to think about, now that you've entered the competition and you're on the way hopefully to winning a prize, is what form of organization will you set up? And we have some experts here tonight from Deloitte to answer that question for us, because it's not an easy question. There are a lot of forms of organization, and it takes into account personal liability limitation, reducing your taxes, a lot of different factors they're going to be talking about. So I think this session, this workshop, is very timely. I'd like to begin by introducing my friend Chuck Carr. Chuck is a partner with Deloitte and has more than a quarter of a century of experience in public accounting. A very experienced guy. In fact, that's the reason why last April at the finals of our 2013 business plan competition, he was one of the distinguished judges that helped choose the winners that actually got the money last year. He's not only a partner, he's in charge of their emerging growth company practice here in this region. Emerging growth company sounds like you guys. So without further ado, I'll turn it over to Chuck, and he'll introduce his partners who are going to help him with the presentation tonight. Chuck Carr.
Thank you, John. Appreciate it. I'm always not sure these days whether I should be flattered by the quarter-century type references or whether I just feel old. But I have been with Deloitte, I guess now over 28 years, right out of college, and who would have known at that time that I would be with the same firm for that long, but thoroughly enjoyed it. And one of the reasons why I've enjoyed it so much is because of dealing with individuals like yourself. It's nice to be part of a room of budding entrepreneurs. You are the types of individuals that I really enjoy working with and for. So basically, I've worked pretty much since the early 2000s with individuals and young companies, executives. Was admitted as a partner at Deloitte in the late 90s, and at that time, this thing called the internet bubble was beginning to happen. So there was lots of opportunities for a young partner like myself at the time in working with young software companies and many other technology companies. That was a great run, and then all of a sudden things burst, as you might have heard. And but as a firm, fortunately for me, our firm decided this was something they wanted to stay focused on, continue to have a practice to work with young companies, help them mature, evolve, do whatever we could. So I was, around that time, put in charge for our region to work just that. And very much a strategic direction of our firm. As you might expect, Deloitte works with a lot of global billion-dollar companies, but what we realized at some point is it's very, very difficult to begin working with a company when they're that size. And so for us, from an opportunity, it was to develop the relationships with very young, energetic, high-growth companies, many of them venture-backed, private equity-backed, really across industries. We see a lot in the technology sector. We also see life science, biotech, medical device, clean tech, alternative energy, retail, restaurants these days. It's really wherever there's essentially investment and there's potential for high growth, those are the types of companies that the practice that I'm involved with, I lead, want to be involved with. So it starts with competitions like this. You never know, one of your ideas basically could result in that next huge, success. Google, whatever it may be. One of our most, I guess, successful, more recent companies was Rosetta Stone. I tell that story because it's just one that I think we started working with them when they were probably $4 million in revenues, and literally their records were sort of in a shoebox. And we worked with them. First audit was a 3-year audit, and they had a vision. They brought in a new CEO at the time, Tom Adams, and his vision was, I'm going to take this company public. He felt they had the wherewithal to do it. And that company evolved over a 6-year period from that point, and eventually was over $200 million in revenues and went public during a very difficult end of the recession period of time. it was just so exciting for me and our firm to work with a company like that, help that company do core audit and tax services, but also to provide many other services and advice and advisory type of things we can do with them. That's what we're trying to do. We're trying to work with companies such as that, that eventually become much larger and continuing to be our clients today. And so it starts, again, with individuals like yourself and what you're trying to do. So as John was saying, we thought as we were thinking about this, what was a topic that would be very important to you and would be necessary, I guess, as you start your businesses. And obviously it starts with corporate structure. So we're going to try to go through the different corporate structures, give you some the pros and cons and what you need to be aware of. And we're also going to talk a little bit about equity compensation, stock options, restricted stock, which you may have some ideas as to maybe that's the way you're going to initially compensate individuals working with yourselves involved with your company. So most of the hard work, the heavy lifting here is going to be done by Todd Swears, who's a partner in our tax group, and Rob Barwery, who's a senior manager in our tax group, and they're going to go through a lot of those. We do very much encourage questions. Really the content for what we're going to go through probably is a half an hour, 35 minutes, and we love it to, to have interaction with yourselves, and I think some of the best ways we all learn is through questions. So I guess that to kick this off, really it starts with you need to have a plan. And I guess not to go too much in this, but you need to have a vision, a plan. But at the same time, I'll say that you need to have a thought that, that plan may not play out just as you'd expect. So always be ready to pivot, change your plan, go with what seems to be working. But also, I guess one other thing I'll just say with that is, before we get into this, is don't be afraid to ask questions. You're going to be challenged with many different things, and this is what I've seen too often. You try to put too much on yourselves and understand that you won't know everything, but ask questions. Surround yourself with smart people. Surround yourself with a lot of expertise, advice. Ask for, ask questions of all of that. And if you do all that, basically you'll basically make your way through it, and eventually find yourself in a much different place than where we started out. So, and I think the next slide just gives you some of the things that you need to consider as you're in that beginning stages, and you're also thinking about, okay, then one of my first major decisions is corporate structure. And there are a lot of things that go into decisions like that. It's not just one, and you have to kind of weigh the factors and what's most important to you as you think about where eventually that company will evolve to, and then what would be best to start out. And I guess the last thing I'll say there is that whatever you start in terms of corporate structure, sole proprietorship, S Corp, LLC, that doesn't mean you have to be that structure forever thereafter. So in many cases, you'll start with one structure and eventually evolve to a different one, especially when there may be outside investment involved, institutional investment. They may dictate and say, we would prefer, if we're going to invest this money, that you move from a flow-through entity, like an S Corp LLC, to a C Corp. So many decisions have to be made. We'll start with, this is one of the more important ones, and why don't we go from there into some of the consideration factors.
So you want to talk a little bit, just introduce yourself.
Yeah, so as Chuck said, I'm a tax partner, new tax partner this year. Been with the firm 15 years. I actually lead in the Greater Washington practice, the Deloitte, sort of the growth enterprises practice, which is sort of the middle market. It's the next step up from the businesses that Chuck deals with. That's where my specialty is, in sort of the middle market. I do help Chuck and involved in the emerging growth practice, but my specialty is really in the middle market clients. And a lot of times, the middle market clients, from our perspective, don't have in-house tax expertise. They have a CFO, they have controller, and they're usually looking to us for all decisions around tax. And so it really is a nice area to develop the relationship with the CFOs and sometimes the owners of the business. And it's an area that I've really enjoyed practicing. I think what we're going to go through is sort of high-level thoughts around the different entities and forms of business that you may think about or consider as you're starting your business. And as Chuck said, oftentimes you'll start in one form of business and then may need to change to another for various reasons, and that is frequent and happens all the time. And as we're going through the slides, if you have questions or want to talk about something, please interject, and we're do our best to answer.
So I'm Robert Baroli. I'm a senior manager in the Greater Washington tax practice. I've been with Deloitte for almost 10 years now, and also a proud graduate of George Washington University, class of 2004. From the MAC program, had a great experience here, so it's certainly good to be back. My client base is pretty diverse. So as Chuck mentioned, Deloitte is a big firm. I work in some big accounts, Towers Watson and Company, British Telecom. But then I also have some mutual clients with Chuck. We work on some of the emerging growth companies. Some companies don't even have any revenue yet. So, when you think about the business competition that you're getting into, and when you think about your entity structure, we've all seen some of the growing pains that you will likely quickly encounter as an emerging growth company. We can talk about some of those stories throughout the presentation later today. So before I get into the slides, just by show of hands, how many people here have seen the show Shark Tank? All right, so about 50–60%. So when you think about it, it's one of the dilemmas that as an entrepreneur is one of the things that is over this time. And it's when you think about, you're looking for investors in your company. Do you want to give up equity? How much equity do you want to give up? What's the value of your company now as a startup versus what it will be in the future versus setting up some type of royalty structure or something else where you don't have to give up as much equity. So, there's a lot of merit to the show. So if you don't see it, it's on CNBC and NBC. It's pretty good watch. So let's go to our next slide and talk about sole proprietorships. So sole proprietorships are indeed the oldest form and the most simplest form. So what's your name? Doug what? Thayer. So Doug Thayer. All right, so Doug Thayer, sole proprietor. Okay, he wants to start his own business, and he wants to sell widgets. So that is inevitably the easiest entity to perform. So Doug is performing services or selling a product. There's a very limited life on it. So that sole proprietorship is going to last as long as you're alive. So we'll talk about some of the pros and cons and how that works next. Sole proprietors account for approximately 12% of all businesses, and we'll go through the different entity types. But just to put things in perspective, it's about 12%. Sole proprietors are not taxed at the corporate level. Sole proprietors are taxed at the individual income tax level. So when you file your tax return, you file Schedule C, which is your sole proprietorship, and you report your revenues, your expenses, and you come down to a net number and you pay tax on that. So right now, individual income tax rates range from 10% to 39.6%, which is a little bit different than the corporate tax rate right now, which is 35%. So there's always some tax planning involved as well when you're kind of teetering on tax brackets.
So ease of that is you include everything on your own individual return. There's no corporate filings, none of that. So from an administration standpoint, it's relatively easy. There's no forms, legal documents to do. You're in business as yourself, essentially.
So as Todd mentioned, it's easy. Nothing special to do. You don't need to register with anybody. You're your own business. You're your own boss. So you get that pride of ownership. As I mentioned, there's no corporate level tax. You're going to be taxed at your own individual income tax bracket. But of course, those advantages don't come without risk. And the biggest risk being a sole proprietor is unlimited liability. So as you mentioned before, you're selling widgets. Let's say one of those widgets blows up, you have a product liability issue. Someone can sue you personally, and you can know what's at risk. Your personal assets, your assets of your sole proprietorship. So there's actually a lot of risk there. So that's why, although it's very easy to form, it's not always the most preferred item. So we have a question on the floor.
Oh, no. Can you speak a little louder?
A little louder? Absolutely. Sorry about that. Yep. One of the other disadvantages with unlimited liability comes, you have limited resources, so it's you. You may have a couple employees along the way, but generally your pool of resources is going to be far more limited. Few fringe benefits, so nobody's going to pay your country club membership. Nobody's going to provide employee benefits for you. You're responsible for providing your own benefits. And again, as I mentioned, you have a limited lifespan. So what happens if you're a sole proprietorship and you decide you want to retire, sell your business, and move into another venture? So being a sole proprietor isn't always the most transferable business form. Next slide. All right, so then the next entity form, we talk about partnerships. So in essence, an association of two or more people who carry on as co-owners. So a couple stats here, 7% of the businesses are in the U.S. are partnerships, as opposed to the 12% that I mentioned as sole proprietors. But although it's only 7% of the businesses, it only accounts for 5% of the true volume, just to put things in perspective.
Seems low to me.
Yeah, it does seem low when you think, because Todd, you do a lot of partnerships, and there's even publicly traded partnerships, which obviously have a much larger pool of investors, so it does seem like a relatively low statistic.
I'm sorry, just to clarify, what do you mean by total volume as opposed to 7%?
Revenue, sales.
Total revenue.
Thanks.
Yep. So in contrast to a sole proprietorship, Todd had mentioned that there's no formal filings, it's filed on your personal return. So you're now a partnership, so you file Form 1065 when you have 2 or more people. When you have a partnership, you have at least 2 partners. You're going to have 1 general partner and 1 or more limited partners. Again, partnerships aren't taxed at the corporate level. Those profits are passed over Form K1, which will actually be taxed on your individual return, which will be at your individual rates. That could be 10%, 39.6%, or somewhere in between.
So,
Sure.
so all like the major law firms, and I'm a lawyer, so
Yep.
the background I come from. So, when you say there's 1 general partner
So-
and many limited partners, is that
so-
like the executive director? Of
So the law firm would be different, because the law firm's like what Deloitte is, which is a limited liability partnership.
Okay.
And so those guys are service-oriented law firms where everyone supposedly has limited liability, right?
Okay.
So it's a little different than what we're talking
Okay,
about
there.
here.
But that's a good segue. So yes, most law firms are partnerships. They're not corporate taxpayers, so they're not paying tax. So when the attorneys get their cases, they're paying taxes at the individual level. Most of them 39.6% if they're good attorneys. And one interesting tidbit, so all the big 4 firms are partnerships. You think about Deloitte, Ernst & Young, PwC, KPMG. You may have thought they were coming into they were corporations. They're not. They're partnerships, so they don't pay corporate level taxes for all of them.
And that's cheaper?
Well, that's a benefit. I mean, one of the things that happens when you're in a corporate form is getting money out, right? And so as money goes into the corporation itself pays tax, right? But then if money is distributed out of the corporation to shareholders, that's when you can get the second level of tax in the way of a dividend. And so a lot of times we say corporations, which are the most common, and most of our clients are corporations, in some ways to get money to investors, it's a little inefficient because the corporation's going to pay, let's say, $10 million or more in taxable income, they're going to pay 35% tax. And then if they distribute money out, there's going to be a dividend that the shareholders pay to the extent of probably 15% tax. So it's not the most efficient form from a tax perspective, but it is the most common.
A general partner and a limited partner can be both an individual as well as a corporate entity as well. Correct?
Yeah, so yeah, good point.
It's a great question.
One of the things that's nice about a partnership is anyone can be a partner. An individual, a corporation, an S-corp, there's really no limit on who can be a partner in a partnership. And as you'll see, there's a different form of entity that we're going to go through where there's special requirements on who can be partners.
Very good question. And oftentimes we will see companies set up that they have their general partner as a corporation to protect from that layer of liability.
So you went over the distribution. Would the distribution be inherent to that legal structure as it's passed through? So if you're a corporation or if you're an individual, how you pass profits from that legal structure, would you still be passing that same distribution through a general partnership or a limited partnership, or would the tax treatment be different in this model?
Well, let me maybe take this question a different way. So to the extent, let's say Robert and I form a partnership and we each put in $10,000, okay? We can take a distribution of $10,000 tax-free because all we're getting is our our investment back. But if we earn, $100,000 in profit, the distribution won't impact our taxable income out of a partnership. The $100,000 of income will impact how much we pay. So if we're 50-50 partners, Robert gets $50,000 of income, I get $50,000 of income. That $50,000 is taxed to me on my individual return. So we could distribute, as long as you have, and this is getting a little more technical, but as long as you have what we call basis in the partnership, you can take distributions out tax-free. And so your basis would be what you contribute in capital, cash, property, and then any profits or income that you've earned increases your basis. Distributions would reduce your basis, and so would losses. And so whenever we're doing partnership returns, one of the things that we always track is what is the basis that each partner has in their partnership, because of the fact that you want to make sure you have basis to take out distributions.
On that term of basis, does intellectual property consider on basis if you're bringing intellectual property to the partnership?
So if you were to contribute intellectual property to the partnership, what your basis in the partnership would be based on what your tax basis was prior to contributing the asset. So if it was organically grown and you had really no basis, you didn't pay for it, there probably would be little basis. Even though we may say there's a lot of value, there may be not much basis in that contribution.
One of the dilemmas we often see in partnerships, I mean, if they have taxable income, so your partnership is making money, so Todd and I, in this scenario, we had $100,000, so Todd picks up $50,000 of income on his return, I pick up $50,000 on my return, but we haven't made a cash distribution because we want to funnel that money back into the business. So the dilemma is then Todd and I are actually we're out of cash because we're paying tax on the $50,000, but we never got a distribution, so we're putting that money in the business. So again, that's one of the dilemmas that often startup companies have.
A very good point.
I think you said Unitech had these 2 partners.
Yep.
So, say if I want to create a partnership by myself, that's not going to work?
That won't work. You won't be a partnership.
You're a sole proprietor.
You'd be a sole proprietor, or you could do another form. You could do an LLC.
What's the maximum number of partners you can have?
There is no maximum.
That's the beauty of it.
That's the beauty.
So actually, you want to go to
Yeah,
the next
we'll go
slide?
to the next slide.
So we'll talk. So I guess talk about advantages and disadvantages. Yeah, as a partnership. So if you're looking for investors, sometimes that is a very attractive way to go because you can have 2, you could have 200,000. There's no true limit on partnership.
And it's easy to admit people, relatively easy to admit people to a partnership. So Robert and I could form a partnership, and then we may want Chuck to join us. It's relatively easy to get Chuck into our partnership. It's not as easy sometimes in other forms of organization. A partnership is pretty easy to get people in and out of.
I mean, just following on the question, without getting too bogged down in this form, because I'm sure there's many more to come, but couldn't you just make a corporation and get in partnership with your corporation? I mean, it seems stupid, like that might just be a sophomore question, but you just said that you could have a corporation. He said, brought up the fact that a corporate entity could be a partner.
Yep.
And so I could be, as a person, a partner, and then my corporation that I created over here could be a partner.
Yeah.
So I mean, it is possible.
Your corporation could be the general partner,
Yeah.
and then you could be a limited partner.
And you could possibly use that as a tax saving vehicle as well.
Not really. I mean, it still has a problem of like passing through. Like every time it gets money passes,
That's right.
There's a loss of it.
So,
Yeah, I mean, I don't think you'd want to, I don't think you'd want to do, if you wanted to be in business by yourself,
Yeah.
from a tax perspective, I'm not sure I would encourage you to go the corporate route early on because of the fact that you can't take money out without it being taxed as a dividend.
And then my last question, sorry,
Yeah.
before we move on, can you loan? We talked about like you not being able to value. Because I was thinking when he asked the question about intellectual property, you could get it valuated outside and then bring it in, but it's more like marital assets where it's sort of anything that grows within the marriage sort of belongs to the marriage. So it's sort of like you're not going to get any money back. But the other way to think of it, I mean, is it possible to loan money to the business or money or property or whatever on an interest with rate so that when you get your money back, besides the investment that you described in the first instance, do it as a loan so that you can just get your investment back, but also with interest. But that doesn't contribute to your base. I understand it's not equity, but you're giving money and then you get it back and plus you get paid more.
Sure. Yeah, you can loan your own personal money to your business. We like to call that, we like to make it what's called an arm's length transaction. So at an interest rate that would be, you would get from a bank or another comparable institution.
Or if, in his example, he had intellectual property. Let's say he has no tax basis, but there's a lot of value. He contributes that. He could go out to a bank and get a loan from the partnership. That's probably the way you'd want to do it because there's value. A bank may see value in the asset that's in there, even though there's no tax basis. You can go out and get a loan that way. And that loan, now we're getting a little more technical, but does create basis to take losses and stuff.
Since you brought up the topic of loaning yourself money or your business money, can you do that through your Roth IRA?
I hadn't thought about that. You're saying can you do it through your Roth IRA tax-free?
I don't.
Correct. In a less complex way than trying to get yourself listed on some exchange and buying shares that way?
I know you can take out of your IRA to buy a house. There's certain things that you can do. I'm not sure that you could do it to loan money to a business.
My gut tells me no. I think there's certain carve-outs for emergency, for medical expenses.
Yeah.
You can make a distribution. You can make a distribution distribution from your IRA tax-free. If you pay it back within 60 days, there's no penalty. You can do it to buy a house. There's a couple other provisions that I don't remember off the top of my head, but to start a business, I believe the answer is no. Not tax-free anyway.
Not without a penalty.
Right. And you know, so yeah, you pay.
Well, I'm not trying to ask for a withdrawal to invest in it. I'm trying to ask investing through the IRA.
Oh, I see. You want to buy shares in a company as part of your investments in an IRA.
Yes.
Yeah, I'm actually pretty sure you can do that. You can buy shares in a privately held company through your IRA.
Oh, I see what you're saying.
Yeah, I don't think like instead of your IRA, as opposed to buying mutual funds or buying stock in an individual equity like GM, GE, or Ford, you want to buy stock in XYZ company.
Yes.
Well, I think you can do that. It presents valuation issues because how do you value the company? What's the share price worth? And obviously there's a lot more risk there. Because it's a startup company, so I mean you're gambling with your retirement fund by doing
Yeah.
it. But
That's an interesting
yeah.
question.
But you're potentially exiting risk-free in 5 years if you're able to grow it. Or not risk-free, tax-free.
Tax-free.
So you're 59 and a half. Seems like an eternity. I think Todd had covered the majority of the points on this slide. The one thing I did want to mention, there is such a concept of a publicly traded partnership. It is very common in the oil and gas industry. And then one other company that came to mind based out of DC is the Carlyle Group. Have you ever heard of the private equity firm? So if you go to SECgov or just go to Carlyle's website, they are publicly traded partnerships. So they're a non-tax-paying entity. Any one of us in the room can buy into the partnership.
What was the name of the website?
You can go to SECgov. That's the Securities and Exchange Commission. There's a whole wealth of information in any company that's a public filer. Free Edgar. Yep.
Can you have more than one general partner?
Yeah. If you have a general partnership, you could all be general partners. So.
Is there a formal, are partners required to file with any organized government state, such as you would file an LLC or you would file? Is there an actual partnership form that you would have to actually sign to officially consummate the partnership? Or are you considered legally a partnership just because of the relationship?
The answer is both. You can have what's called a de facto partnership. Sometimes we have clients that didn't intend to enter into a partnership, but despite the fact that they didn't have a formal agreement, they're for tax purposes a de facto partnership. But generally, most of our clients have a partnership agreement that is pretty well detailed. Usually they run about 60 to 75 pages, which spells out every single painful nuance. And Todd and I, as part of our clients, as there's a lot of tax implications on how capital accounts are allocated and so forth. So most companies who are well organized will have a partnership agreement.
Yeah, and we should have started it off. One of the things you would do is file with the IRS to get an employment identification number. And so you would do that, and you would likely want to register to do business in the state. It's more of a legal question than a tax question, but generally you want to do that for legal protection purposes. To register to do business in the states that you're operating in.
It's Form SS4, right?
Yeah.
Yeah, you can actually go to irs.gov. You can actually get a business entity classification through the website. I think we talked about a lot of advantages and disadvantages. Obviously, you can put your money together. You can pool resources. So as opposed to being a sole proprietor, you can have money, different pools of money, longer survival rate. The one thing that I think is probably worthy of noting. So you had touch on the whole having a partnership agreement. So let's say Chuck, Todd, and I, we want to form a partnership where we want to perform accounting services. So let's say we said, we're going to do this for 3 years, and let's see where it goes. At the end of 3 years, let's say Todd wants to retire, Chuck wants to go and do other things, I want to stay in the partnership, and then we disagree that we have different visions on where we want to go with the company. So how do we resolve that? And generally, the partnership agreement is the whole point of resolving issues in advance and how to settle those types of things.
But it can cause stress and difficulty in private companies. Valuation issues can come up. I have a friend that's actually going through this right now. We have someone that's trying to exit a business, and how much did they get paid and all that. So that can be a challenge.
So the moral to the story is don't ever get into business with your friends or family. Nothing good comes out of that.
Is there any particular form of legal entity that benefits you or disadvantages you from your investment standpoint and tax investment schedule? The share ownership that you're taking on company and or distribute to future funders?
Okay, so if you're an investor in a partnership, you're going to get Form K-1, and that Form K-1 will pass on every component of income from that partnership. So the ordinary income from the partnership, or ordinary loss, will be taxed to you as ordinary income. The partnership has capital gains, short-term versus long-term. Those attributes will pass to you as short-term and long-term. Does that kind of help you out? So then if you're a corporation, you invest money in the corporation, as Todd mentioned, it would be subject to double taxation. So the corporation is going to pay tax at up to a 35% level. And if that corporation makes a distribution or a dividend to you in excess of your basis, so now you have a taxable dividend to you. But if you have more questions, we can chat after class. Sure.
Do you have any restriction in this level structure if you are a foreigner?
For a partnership?
For partnerships and
No.
sole proprietors, no. One of the entities, S corporations, do have some restrictions, and we'll talk about that a little later. But I think that's probably a good segue to our next slide, which talks about corporate structures. So corporations, 18% of businesses in the United States are corporations. When you think corporations, sometimes you might think big, publicly traded corporations, but a corporation can be publicly traded or it can be privately held. So there's no requirement to be public or private. Essentially, it boils down to three key groups. Your shareholders. So what is the CEO's number one job? To maximize shareholder wealth. So you own stock in the company, you're hoping your stock value goes up, the company pays dividends. So as a shareholder, you have a vested interest in that company. The board of directors essentially is the governing body that oversees the company, make sure its vision is being executed by its officers, and they're the ones who select the officers of the company. One interesting tidbit, any guesses within $10,000 of what the average board of director member makes for a publicly traded company?
150.
Wow, I'm impressed. Between 150 and 165. Yeah.
Not like I looked that up or anything.
Yeah. So roughly, someone who's in the board of directors, which could be anywhere from 8 to 15 people of a lot of publicly traded companies, is about $150,000. And they meet. Chuck, I don't know what your experience is on boards, and there's some of the emerging growth companies, the boards might be much more active. On the public side, they might be quarterly.
They tend to give a lot more advice, so they don't get paid the same as the public company boards. They may take more equity, in the early stages, and that's their risk, but maybe monthly. Or maybe the larger public, maybe not as often, but certainly at least quarterly.
Yeah, that's actually a good point. So you have an emerging growth company that doesn't have a lot of cash, and it's trying to put money in R&D and grow operations. So you're trying to attract good board members. You can't offer cash, so what can you offer? As Chuck mentioned, you can offer equity in your company. Equity in a company that has a good business model and a promise for growth. What do you think the original board of directors who on Microsoft got? I don't know, but when you think about it, maybe they weren't paid at all. Maybe they each got 10,000 shares of Microsoft. It'd be an interesting tidbit to
I think they all owned stock
research.
in the company and didn't get paid anything.
Right.
That's a normal thing for startup companies.
Is there anything different we need to know about this in terms of the pioneering sort of version, the benefit corporation, or do we talk about that later?
I think we're going to talk about the benefit corp later. I think we have an in-house benefit person that we'll refer
I
to.
think you guys were going to tell us because you were on the cutting edge right out there.
Way to set us up.
We got the in-house. We've been doing the in-house.
No, I will tell you that taxation of benefits and nonprofits are its own beast, and we'll touch on those. No, I understand. So, but the benefits in 409A, that's just a completely separate animal.
Are the directors of the shareholders
They can be. They can be shareholders. But they don't necessarily have to be shareholders. Often you'll find that in large public companies they're given annual stipend plus equity, some type of equity compensation. For a smaller company who doesn't have a lot of money, they might just get shares.
Is it true that depending on your jurisdiction and where you file your paper, it will restrict or allow you to have more than a certain amount of shareholders or directors, or some may allow you to have one single shareholder, one single director. Doesn't your jurisdiction determine what the policies are and what criteria is required for you to actually form that corporation?
Sounds like you're asking a question about state law. So if you're a Delaware corporation versus a New York corporation versus a Nevada corporation, you're saying, are those state laws different than what their incorporation requirements are?
That would essentially imply what, how many you would be able to need to have in place before that corporation could actually be formed.
Yeah, I think most states have a minimum. I think you have to have at least 4. I think you have to have like a secretary, a treasurer, a CEO. Yeah, CEO. I think most states require 4, but it does relate to, it is a state law question, and actually it's a good segue. So a lot of companies do actually incorporate in the state of Delaware. The state of Delaware is well known to have very sophisticated corporate law. So it just so happens that a lot of your larger companies you'll find are incorporated in the state of Delaware. General powers of a corporation, it is a separate legal entity. So as opposed to a sole proprietorship, it has the ability to sue on its own behalf and be sued by shareholders or others. The continuity of life, so it goes on in perpetuity until the corporation is annulled. To your point, it does the ability to amend and make bylaws based on the state laws of incorporation. And has the right to enter into contracts and borrow money as its own individual body.
And long term, most companies that are publicly traded are in the form of corporations. There are some publicly traded partnerships, but most, if down the road, if companies are planning an IPO, most migrate to a corporate form. It's taxed. For federal tax purposes, I don't know if we talked about that, but up to 35%. And states, the states you operate in, you'll generally pay a corporate level state tax, which can be up to 10%. So the combined rate could be something in the neighborhood of 43%, which pretty high.
I think that's a great focus. Our presentation really focuses on federal taxation.
Yep.
But Todd makes a really good point. We're really going to touch on state. That's its own animal in itself, whether or not you have to file a tax return in different states. So you take some states, like the state of Maryland has an 8.25 corporate tax rate. So you're paying 35% federal, then 8.25% state rate. California's 8.84. What's Virginia?
Virginia is 6%.
6%.
Yep.
So that's actually a great consideration. What state do you want to organize your business in? Do you want to organize in Maryland and pay 8.25%? Do you want to organize in Virginia and pay 6%?
Yeah, and there are different things. That go into obviously where you want to go from a state perspective. There are credits and incentives that companies or that states have for job growth. Virginia has something around, if you grow 100 jobs in Virginia, they'll give you a credit up to $1,000 an employee. Maryland has a job credit as well. And so there are different rationales. When big businesses move to states or they're thinking about moving jurisdictions, they actually contact the state and negotiate incentive packages because it creates jobs. And most states are motivated to have job growth in their area.
That's a great point. One thing I was going to add is, so one of the companies that recently moved from Los Angeles to Falls Church, North of Drummond, the big defense contractor. So they went to the state of Maryland, they went to Virginia and said, okay, I've got jobs, who's going to give me a package? And the package that the state of Virginia gave was far more lucrative than what Maryland did, so they decided to headquarter in Virginia.
Washington is, D.C. is 9.975 as a starting point, so it's high. There are different areas in Washington that if you qualify as what they consider a qualified high technology company, which is sort of 6 broad categories. It's basically if you're a software company, a technology related company, you may qualify, and if you're in the right zone in DC, you can get actually a 0% rate for 5 years. And there's some exemptions around sales tax and property tax. And then if you qualify for this type of company, then once you're done with that 5-year 0% rate, then your rate goes to 6%. But it's a lot better than 9.975.
That's a good point. I don't know if anybody's seen the advertisements on TV for the state of New York. Operating, I think they're offering, if you want to start a business in New York, they'll let you be tax exempt for the first 5 years in the state of New York now if you're a new startup.
Really?
Yeah, and I've seen the commercials on TV. It's pretty powerful, and they're advertising. I live in Maryland, so they're advertising in Maryland. Hey, Marylanders, come on, start a business up in New York for your first 5 years. Now, with that being said, as an emerging growth company, your first several years of business, most companies, not all, have losses. So your first 5 years might be when you have your losses, so there may not be a true tax benefit to it.
The scenario that you painted of the Delaware Corporation, let's say you're operating a corporation in a separate state from where you're actually planning to have your actual home-based business. Your business activities in the state outside of your incorporation, would you be required to form qualify in that state, or could you operate out of that state without penalties? How would that?
Well, I think what you're asking is, let's say we form a company and we form it in D.C., but then we have customers in Maryland and we have customers in Virginia. So if you are doing business, and states define doing business differently, and for income tax, the key for us is nexus. If you create nexus, which is more than a minimum contact to the state, if you go in and have meetings and provide services, more than just ancillary contacts with the state, then you're required to file the state income tax return in that jurisdiction. And we have a whole state and local group that spends a lot of time around nexus and what creates nexus. And a lot of times you have employees that work out of their house, right? And that's going to become more and more important, or more and more common, I think, as this technology changes the way that we operate. And does that create nexus? And those are things that you got to consider. But generally, the way that I think about it, if you're regularly and systematically doing business in a state, you probably have a tax filing requirement.
That's actually a great point to add on to that, just to put things in perspective. So Deloitte's Greater Washington tax practice is about 110 tax practitioners between Baltimore, McLean, Virginia, and Richmond. Of those 110, we have about 25 people who specialize in and do nothing with state and local taxation. So it is a very technical, and it's a specialized field. People can spend their whole career doing nothing with state and local tax.
And that would pretty much depend on how the IRS views your employee, whether you're actually acting as a contractor to that organization or you're actually a bona fide employee.
Well, that's more of a federal tax issue. So are you an employee versus an independent contractor? And if you go on the IRS website, you can actually look that up. There's some pretty good resources that they have. It's a very subjective test, and I don't know nuances, but there's about 20 different factors that the IRS will consider upon exam.
It's pretty clear.
But generally so, yeah.
Just for the record, Microsoft actually was already a really going concern before it incorporated. It started as a partnership in 1978, made a bunch of money, and moved to Washington from Albuquerque, and that's when they got their work here. So they probably did pay it.
So that's a good. So as Chuck alluded to earlier, you may start off in having one entity form. You might start off as a sole proprietor, an LLC that we'll talk about soon. You might start off as a partnership like Microsoft did, and at some point in time, you may get bigger investors to say, you know what, fine, I'll give you my money, but you have to be a corporation. You're going to have to incorporate. Question in the back.
Is there a consistent policy on the taxation issues regarding interstate commerce across state boundaries? In the U.S., is it now consistent, or it's depending upon the state?
So there is a, when you talk about consistent policy, there is a public statute called Public Law 86-272, and it sounds really fancy, and I don't know any other public laws other than Public Law 86-272, but that does govern generally nexus and filing requirements among states. That is a public statute, but then every separate state has its own set of rules.
Yeah, I mean, I think there's a push to do that, but I don't think we're there yet. Right? I think that
do we err on the side of caution that we keep taxes in bay when the day comes that they're going to charge Amazon, for example? Or do we not?
You're talking about sales tax.
Well, commerce tax. I mean, that's a gray area, but it's a significant risk for companies going ahead in modern era.
Yeah, I mean, I think it's something you want to be, you'd want to consider. There's a partner or a director in our practice that specializes in sales and use tax, and it is. I know that every state's different, and I know that it's a challenge that emerging growth companies have is, when to pay sales tax, when to remit use tax or sales tax on sales, and there is no one size fits all, unfortunately, and it gets pretty complicated. So that's one that I would, if you start to have a lot of sales and you're going across jurisdictions, you're on the internet, that would be where you definitely want to bring in someone to help sort of look at the different jurisdictions and when is it taxable and when is it not taxable and all that.
The one thing I just realized, I'm going to pause for just a second. I realize it's almost 6 o'clock, and I think we were supposed to pause then. So if you don't mind, if we could hold all questions till the end, we'll be glad to take Q&A at the end, or if you want to come talk to Todd and I. But I think we're just going to kind of go through the slides, make note of any questions, and then we'll kind of go from there. I apologize for being a bit lengthy, but you guys, I'm actually impressed with all the questions that we're getting. We're very encouraged by that, and at the end, we'll definitely give you a chance to do that. So from a corporate perspective, there are two types of corporations. Most companies, when you think about it, your big corporations, they are what we call your subchapter C corporation. And we've talked about all the details about C corps. There is a special corporation, which is called a subchapter S, a small business corporation. It offers most of the benefits of a corporation, but it's kind of a hybrid between a partnership and a C corporation in that S corporations don't pay corporate level tax. So similar to a partnership or an LLC, those profits will pass through to the individual investors. The restriction there is you can only have one class of stocks, like a common stock, be limited to 100 shareholders, and those shareholders must be U.S. residents. So there's a lot of advantages to an S corp, but it is a little more restricted.
Yeah, and a lot of closely held family businesses are organized as S corps, and it's a fairly common closely held business structure. But there are restrictions that you got to worry about in terms of shareholders.
So I think we've talked about a lot of these already, thanks to your very good questions. Talked about advantages and disadvantages of a corporation. I guess just to highlight a few that we haven't talked about. When you're a corporation, you have education assistance, meals and lodging. You get fringe benefits. As a sole proprietor, you're funding you're your own boss. So you're funding your own benefits, which often as a sole practitioner or being self-employed is very expensive. As an employee of Deloitte, I get my health club membership, I get insurance premiums, I get life insurance, so I get all those fringe benefits. I get a pension, 401k, which you don't get. So when you're thinking about hiring and you're trying to retain talent, sometimes it's easier as a corporate form, having many more employees to go in the corporate format.
I think the big disadvantage we've talked about is the double tax in corporation. Getting money out tax-free is not the easiest thing to do. So that's one thing to consider.
And then LLCs. So LLC is second to a sole proprietor, is probably the easiest company to form. I'm a Maryland resident. You can form an LLC in Maryland for $100. It's pretty easy to do. It's a very flexible format. Again, it's a hybrid, so there is no LLCs are generally not taxed if you like to be.
The default for an LLC is generally to be passed through for tax.
Partnership, right.
So a partnership, and we would file a partnership form. So you have the benefits of being a partnership, whereas the entity itself isn't subject to federal income tax. But you have some corporate legal protections that you may not have in, say, a general partnership.
Yeah, I would say that's probably the biggest advantage to going to an LLC. You operate the same. There's not a lot of administrative difference. There's not a big tax difference because all the profits are going to be passed to you personally, just like it would be in a sole proprietorship. But you get an LLC, you'll get legal protection. So if somebody can't sue you personally, they can sue your LLC. So the only assets at risk in the event of a lawsuit would be in the LLC, and likely as a startup, probably won't be a lot. They're probably a lot less than what you would have personally. So your Roth IRA, if you created an LLC, if you got sued, probably they wouldn't, because the corporate failed, so come get your IRA.
What does that mean for transferability of interest?
Well, I think what we meant was it's sort of easy to get in and out of like a partnership. it's easy to admit members and things like that.
Next slide. So I'd say that this slide is probably worth the price of admission for tonight. To be honest with you, because this is a quick summary of one is entity best. So if you have a camera, you might want to take a picture of that. We'll give you a section.
It's amazing how
old I am.
I would have never thought to do that.
Because when I went to school here, I didn't have it. I thought it didn't exist.
I didn't even have a cell phone.
I got you.
Yes.
Yeah, they'll be on the gwbizplan.com website eventually.
There you go.
All right, so what I was going to just briefly touch on is equity and types of equity that we commonly see that you may want to consider in terms of granting to your employees, to yourself, and some advantages and disadvantages of the different types of equity we see. So there's what's called incentive stock options, which are otherwise known as statutory options. And the reason they're called statutory options is because there are statutory provisions that you need to adhere to get the treatment that I'll talk about. And some of them are that they have to be granted to an employee. So a board of directors person or a contractor could not get an ISO. It only can be granted to an employee. It must be granted under a plan that sort of specifies how many shares they have, etc. Each tranche of incentive stock option for an individual cannot exceed $100,000. So once if I were to give you $150,000, the first $100,000 qualifies as an ISO, and the next 50 would qualify as a non-qualified. So there's restrictions on how much you can grant in any one year to an individual.
Is there like a workaround? Like, well, I'll ask questions later, but like people like Nelson and all these people, they figure out workarounds like that they can't. I mean, they're on the boards, but then they also.
Well, there's different equity that they'll get. They won't get incentive stock. So the benefits of an incentive stock option, if you meet this 2-year from grant, 1 year from exercise, is that the employee is actually not taxed as ordinary income. They don't have income. What they have is, on their individual tax return, a preference item for alternative minimum tax, which may or may not cause them to be an alternative minimum taxpayer. So if you do grant incentive stock options, make sure, you want to make sure you understand that. I have a close friend who, when we started at Deloitte, had the pleasure of calling someone and telling them that they had a huge tax bill because of an AMT preference item, and they were completely not prepared for that. But because if you meet this 2 years from grant, 1 year from exercise requirement, not income to the employee, it's not deductible by the company for tax purposes.
Yeah, generally, the feds like to see a matching, so nobody's picking up income, nobody's getting deduction. Correspondingly, when the employer gets, when the employee picks up income, then generally the employers.
How common do you see ISOs in the emerging growth?
I see much more of a non-qualified.
Yeah. This used to be more and more popular. I do have a couple of clients that have ISOs, but I don't see, and the clients I have, the ISOs are gone now in terms of the grants, and now they're just, every now and then I'll see exercises come through, but I do not see this form of equity as often.
For a private company, how do you value the stock option?
Well, that's a very good question. Technically, you want to get an appraisal, and there's probably around once a year you would get an appraisal around the equity that you've granted to basically set the value for that year's grant or that sort of tranche of shares as you grant it.
So you've
Chuck, you probably see that.
Typically, one of the major assumptions with that is the value of the stock. And then from there, you value the stock option itself, which is usually done through a binomial model, Black-Scholes model, or something of that nature, which will value the actual stock options. But usually, most of the private companies that are out there, if there's not third-party transactions, arm's length transactions of buy and sell, then you typically will get an external valuation to do some sort of fair value valuation.
And is that like once a year, typically?
At a minimum.
At a minimum.
More high-growth companies, as they get closer to doing a public offering, they may be doing it monthly or quarterly. But it just begins, the frequency will increase as the company increases in value and they get closer to a possible public offering.
So basically, if your employee granted a stock option with a startup, and the valuation goes up, and you're in a stock at very low strike price, you do not have to pay the capital gains that year on the income.
Well,
I mean, like, how is capital gains treated like, you know, in stock?
So if I exercise, well, maybe I'll go through the rest of the shares, and I can answer that specific question because it's different. So if you exercise an incentive stock option, all that happens is in the date that you exercise, the difference between the value on that date and your strike price is not subject to ordinary income tax. It's subject to alternative minimum tax. So no tax today. And then your basis in the share is the value on that date. So that if you were to sell it down the road, that capital gain would be on that difference for an incentive stock.
So you're not taxed until you sell.
Yeah. Non-qualified stock options, which are what we see more and more common, these are granted to employees, but they could also be granted to board of directors. The difference between non-qualified stock options and incentive stock options for tax purposes is when these are granted, it's a non-tax event, but when they're exercised, the difference between the value on that date and the amount that you pay for it is ordinary income to the employee. So that would be taxed today. And so if you don't sell your shares, if you're in a small company and there's no way to sort of exit, you got to pay tax on the shares that year, and you got to think about, well, how am I going to pay my tax? What form of cash do I have? And because the employee is picking up income, the corporation will get a tax deduction equal to the income. The other sort of common equity instrument that we see are restricted stock. And the difference between sort of like a non-qual, the way that I look at it, a non-qual and a restricted stock is generally this is property granted to an employee, shares that are granted to an employee that vest over time. Sometimes it's a 3-year vesting, sometimes it's a 4-year vesting. On the date of grant, generally there's no tax implications. And as the shares vest and become your property, on the date that they vest, you're taxed to the extent that the difference between your fair value and the strike price is ordinary income. So the company will get a deduction, and it just usually it's yearly vesting, and so each year you'll pick up income and you'll get equity. You can make what's called an 83B election. Within 30 days of grant of restricted shares, you can make an election, file it with the IRS to basically say, okay, I'm going to remove all restrictions for tax purposes. Legally, I still don't own the shares, but I want to remove the restrictions for tax purposes because I'm betting that this company is going to go, do really well. And so I'll pay tax today on the value, which is probably very, very little gain in that 30-day period. And so I'll pay tax today on that amount. And then in the future, when I sell it, that difference is capital gain. And so
tax at 15%,
tax at 15
versus 39.6% at your ordinary rate. So it's about a 25% rate arbitrage benefit there.
So you're really betting on the company. You're really betting that the company is going to grow and grow well. And so you want to take ordinary income today a little, and because you think that the stock price is going to go up, tax rates are going to stay the same. There's a capital gain, sort of benefit. And so, that's sort of an individual personal decision. I do have a client that actually last year made an 83B on a large number of shares and paid tax.
I have one as well, but there's one risk with the 83B election. If the stock goes down, you are out of luck and you do not have a deductible capital loss.
Capital losses.
Wow.
Yeah.
Capital losses are only utilizable by an individual to the extent of capital gain or $3,000 a year. So capital losses are bad, and so that's the risk of the 83B. Is if you bet wrong, there's not a lot of benefit to you. So that's equity. I think the last slides we wanted to briefly touch on was nonprofit.
Yeah, in the essence of time, we'll talk about it. So I think as part of the competition, there's some prizes for social welfare and not-for-profit organizations. I thought it would just be helpful just to go through, I guess, some of the general requirements and what's done with the IRS with respect to nonprofit entities. So if you're looking to find out information on nonprofit entities per se, you do two things. Number one, you go to irs.gov and just Google search Form 990, and the publication, the instructions to the form are pretty daunting. I think the instructions are about 85 pages, and the Form 990 has actually been subject to scrutiny by the IRS for the past several years because a lot of companies have been claiming that they're nonprofit, they really have a tax exempt mission, but it hasn't been the case. So the IRS has actually expanded very much so the scope of its non-for-profit audit status. Also, if you want to go to guidestar.org, guidestar.org, so once you file for 501c3, that actually becomes public domain, versus if Todd and I have a partnership, that tax return is not public, it's not public domain. But when you're a non-for-profit, there is a certain level of accountability, so that's actually public information. File Form 990, again, nonprofits generally don't pay taxes. There's a few exceptions to that. Again, there's small. There's a $50,000 exemption. The one thing is organizations that have unrelated business taxable income. So let's say you're in the mission of providing affordable, low-cost housing, and you want to do bingo night or gambling night to raise money. Well, that would be unrelated to your mission. So that would be unrelated business taxable income, which would be subject to corporate rate. So the whole point is there's a sting tax associated with doing events that are tainted from a non-for-profit perspective. Next slide. So 501c3 is the most common organization. Again, religious. You have your churches, mosques, educational institutions. I believe GWU is a 501c3. Again, you'll see a lot of the common denominators there, and then you get some of the other oddballs that Todd and I don't do a whole lot with. So is anybody here president or like treasurer in your fraternity? No?
Yeah, but one of my clients is they're a great group, and so, yeah, I mean, it's out there.
Yeah, so there are various organizations that have, other than what we hear, the typical 501c3. That's just a list of them. Do you have anything else? That is it. So, first of all, thank you so much for tonight. We appreciate it. We got such an influx of questions. I do want to give a chance for our employee benefits speaker to talk on a few things, so I'll turn the floor.
Okay. So I'm Melanie, I'm the coordinator for social entrepreneurship, so I'm going to speak very briefly about B Corps and Benefit Corps. So does anybody know any national B Corps? Does any name come to mind? Are you aware of anyone? I don't know. I'm just asking if anyone has heard of them or know them. I don't know every single one. There are 900. Some major ones that are national level are Patagonia and also Seventh Generation, the cleaning company. So those are two national level ones. Has anybody eaten in a B Corp in DC that's well known? And one of our mayoral candidates may or may not be the founder of that restaurant. Yep, Busboys. So Busboys and Poets is a B Corp. You'll see a black B with two lines, and that indicates that they have received certification. So I'm going to read you the distinction in the definitions of a B Corp versus a benefit corp. B Corp versus benefit corp. I mean, it almost like very confusing, very similar, but just to give you a flavor. So B Corps are certified by the nonprofit called B Lab to meet rigorous standards for social and environmental performance, accountability, and transparency. So that's their definition. Then you can go, benefit corps are a new class of corporation that are required to create a material positive impact on society and the environment and to meet higher standards of accountability and transparency. So if you didn't hear it, it's almost exactly the same language. So the distinction between those two, if you're making a decision to go for one of these, is that B Corps are available around the world. It's focused in the US right now, but they're getting some interest from abroad. And that is a kind of like a test you take, and if you could score an 80 out of 200, you can be a certified B Corp because you're meeting standards set by this impartial group of academics and business folks that make up their board. And you have to keep meeting those standards to maintain that. So I know for Busboys and Poets, for instance, they do locally sourced food and they also give benefits, health benefits to all their wait staff and everybody, as I understand. So they do above and beyond what a normal restaurant would do. So that's B Corps. You're being certified. You're going to, you want to write this down, it is bcorporation.net is their website. And you can get a sense of what their assessment is like. If you want to be a benefit corp, that is the legislation you may have been hearing about that's been passed now in 17 states, including DC. So that's Maryland was the first to pass this legislation. Virginia's in there, DC is in there. What this means is that you're also meeting high standards for social and environmental impact, but you don't have to be, there's no third party certifying you, essentially. So there's standards that are set, but no one's going to, and you have to give an annual report every year, but no one's going to basically check that what you're saying is true, and they're not going to keep following you around, kind of thing. What makes this really interesting is, so I didn't really define exactly what a B Corp or benefit corp, since they're so similar, what that really means. What that means is, when you have your corporation, you can take in social and environmental concerns equally or more strongly than perhaps a corporation that is fully beholden to their profit-seeking shareholders. So they're taking stakeholders that are concerned with the environment, if they're a local indigenous group, like they're interacting with all these different kinds of groups that they've baked it into their DNA, as they say, to be concerned with it. So in a way, they're not going to be maximizing profit. The interesting thing is, and everyone is waiting for this to start going to the courts, is that some stakeholders can sue you, potentially, if they don't feel like you're doing enough for the social and the environmental bottom line. And the reverse, that potentially the ones who want the profit could also get a little bit upset at you and take it to court. So everyone is aware that how do you really define those standards and keep yourself out of trouble as a B Corp. But for now, most B Corps are not very large and powerful, so they're not necessarily publicly traded too often. And last I know, I don't think Busboys and Poets is on the stock exchange. So it's really just more of a symbol and a certification that I, as a company who wants to make profit, also really wants to put social and environmental bottom line first. So that is the very general overview. And so again, it's bcorporation.net. And if you want to look at the other website is benefitcorp.net to look at benefit corps. So, oh, and just a little tidbit of information, speaking with the organizers of the B Corp certification. They say that typically a standard for-profit corporation would get about a 20 to 30 out of the 200 points. So if 80 sounds low out of 200, they say it's actually much higher than many would achieve. Thanks.
Do we have time to take a few more questions? You guys don't have to run.
Yeah. I guess I would have two questions. One, have you had any experience with any of the benefit corporations? And isn't it true that by incorporating that way, like for instance in the Virginia arena, you would protect you? You're actually creating protection for your leadership because they written into the bylaws. Your fiduciary responsibility is dual now. I mean, written in stone. It's not just that profit. It is maximizing profit. It's not like you don't maximize profit, but at the same time you also have this really, which bylaws already have, but this one is like a social one, which is difficult to evaluate. But, isn't it a protection? And have you had any clients yet doing this?
I have one client that has asked about it probably about a year ago, and that's
so you talked him out of it right away.
We know very little, and there wasn't much.
Is it going to hurt us in the competition if we use that, since it was one of the rubrics that was instructed?
No, will not hurt you.
Thank you.
We're looking at your business plan.
Could you go over the legal structure of a master limited partnership and a limited liability partnership?
So Deloitte is a limited liability partnership. Okay. As Todd mentioned before, so there is a limited liability for each partner. So Jeff and Todd are partners with Deloitte, Deloitte Touche, Deloitte Tax LLP, limited liability partnership. So there is an element of risk. Each partner has a personal liability insurance. So if Todd signs a tax return and there's an issue with the tax return, Todd can sue. If there's an issue with the audit opinion, when Chuck signs off an audit opinion, there is an element of risk there, but it's a lot less. With respect to master limited partnership, heard of them, haven't done anything with them. I don't know, have you done anything with master limited LLPs? I know that there are some master limited partnerships that are public, but it's really more of a legal question. It would be, from a tax perspective, it's taxed very similar to just a general partnership.
This is similar to an insurance question. At what level do you recommend corporations buying directors and officers insurance where, I mean, major corporations buy hundreds of millions of dollars worth for their board, but if a small company is making a physical product that could harm someone, even an LLC, I mean, you can still break that corporate veil. I mean, it doesn't totally protect you.
I guess on that sort of thing, as I mentioned at the very beginning, there's lots of expertise in different areas, and that's the one that I would probably ask someone other than myself.
D&O insurance is pretty pricey. Most startups I've been with, they just rely on the corporate shield, or LLC, the limited liability shield that's built into your entity, because you really can't afford to buy it when you're a startup. So the answer is, when you have to be big enough to be able to afford it, then you could add that layer of protection. But technically, as a shareholder, you're protected by the corporate shield or the LLC shield or the limited liability shields, multiple ones, that you just heard described. You could still be sued personally, but that's kind of rare. Usually it's a product or service you're providing that is brought on the lawsuit. And so then you are protected by being just a shareholder or an employee of a company that would be sued. Thank you.
So I'm just kind of curious what your experience has been with international students, kind of the limitations, as well as phone calls that arise, maybe from going from a student to someone who wants to start their own company or their own kind of partnership in the U.S. So if you guys can maybe just talk a little bit about that. Really appreciate that.
Well, I would say so the one entity that has the most restrictions is an S corporation. So you have to be generally a U.S. resident, a U.S. taxpayer to be as part of that. So let's say you were seeking additional investors, and those investors were overseas. They would not be eligible investors for purposes of an S corporation. But if you want to just form a partnership, you can do that. You can have as many investors as you want, and they can be from wherever.
So I guess the question is kind of, is it quite common for international students to start their own companies as well and see them grow? Or are there really restrictions such that you're not actually allowed to start a company as an international student here?
I don't know the answer to that question. I can, from 2000 to 2010, I was not a U.S. citizen. I was a foreign national. I opened my LLC with a Nevada registered, LLC with a resident agent, and I ran business, quite a successful one in satellite industry. And my corporation paid taxes every year because we were earning a lot of money. I had offices in Washington, D.C. At that time I was overseas, but I had offices here. And I elected, as president, CEO, and chief, whatever, I elected S Corporation. I was actually a foreign national all the way. I was not a U.S. resident. I got my green card in 2005 with a national interest waiver in Colorado because of my business history. But at that point I showed that, hey, I've been doing all this business in the U.S. So they actually recognized all of that.
When did you elect S Corp status? Was it
every year since May 21, 2000. So that was all done through, I wasn't even here. I just arrived in 2005.
You have residency abroad.
Well, a long time ago, I did my bachelor's here in the U.S. I went on back there.
So were you filing an individual 1040 in the U.S. during those years?
No, 1065. I'm a partner.
No,
so that's a partnership.
Right, that's a partnership.
Yeah, my structure was that partners were my family members.
Right.
Yeah.
We were all overseas.
Yeah.
I'd come to the U.S. on a business visitor visa. I had gone to Nevada, set it up, and went home. All right. So basically, 1065, and then the Schedule K1 got filed.
Yeah.
But I was filing 1040 NR.
Right.
That's right. Yeah. All right. So basically, it all basically got sent back to me because ultimately I didn't owe any taxes either in Nevada or in any of the United States. I was just an international investor at that point. Now, it might have been early days of, the IRS, taking a lenient view about this, but it actually all came down to it when I applied for a green card on an expedited basis, and I showed my entire corporate history. Here's my business, I've got this business running, and they accepted everything. So everything was audited.
Yeah, you can be a partner. You can be a foreign national and invest in a partnership. You just can't invest in an S corp.
But the S corp choice was my CPA's choice. The CPA basically filed paperwork that I was an S corp for taxation purposes.
So, but you filed it. Well, so an S corp filed was called an 1120S.
Right. I have 1120S.
Yeah. So. Yeah, there are always exceptions, I guess.
I mean,
do you get audited?
I'm here because of that process. Yeah. But with regard to the gentleman's question, I was a foreign national through and through, and followed all the relevant regulations.
Yeah, I think it may come down to a legal question about what your visa will allow. Rather than.
If you're a foreign national with a serious visa, you could set up a business. You can't pay yourself a salary. That's important. You can do all your expenses. You can account for your expenses with a business credit card, business, hotel stay, business card stay, everything. You can do everything under the corporate banner as long as you account for it. QuickBooks. All my records are in QuickBooks from 2000 onwards. So to current time, basically, I've been maintaining that set of accounts. The only problem is paperwork. A lot of it. So when I eventually rented an office, 15th Street Northwest, by the corner of the White House, it was like a nightmare for me to do paperwork from over there to here. Telephone bills, internet bills, whatever, resident agent bills, local tax bills, whatever bills.
There's actually a couple apps. Like if you have an iPhone, there's a couple mobile apps that will help you track expenses for small businesses. Like there's an app for real estate agents to help you track your mileage, because one of the important things is being able to substantiate your mileage along with how many miles you travel. So yeah, no, not back in that thing. But there's some apps for that nowadays.
You can pay for most of your expenses as long as you don't pay yourself a salary.
What are those apps?
I don't know. Off the top of my head, I don't know. We're not actually supposed to recommend any apps, so I'll play them because we're not supposed to endorse any particular product.
You guys kind of rushed through LLC, but what are the major differences between LLC and, say, S corporation?
So an LLC is it's a limited liability company, right? And so the difference between an LLC and a corporation is a legal. So an S corporation is a corporation that files an S corp return. The restrictions for an S corp, aside from what he talked about, were 100 shareholders. You're limited to 100 shareholders. One class of stock. So everyone. Here's the thing. With an S corp, everyone gets whatever their. Let's say all three of us form an S corp, right? And we each get 1/3 of the business. The requirements are we each get 1/3 of everything. There's no flexibility in that. Everything has to be pro rata. We can form a partnership, or an LLC, and there's a little bit. There's some planning that can be done around allocations about how much. I may contribute a certain amount of cash, but I may get a little bit different profit interest. So there's more flexibility around allocations with a partnership. An S corp. One disadvantage of an S corp is state taxes. Sometimes states don't respect an S corp, DC being one of them. So in DC, you actually pay a corporate level tax if you're an S corp. And again, it's 9975 as a general rule. What else? LLC is just like a partnership in a lot of ways. It's just limited liability company. So all the flexibilities around partnership, everything's taxed to the shareholders. Most states follow the rules and don't tax LLCs, just like most states don't tax partnerships on an income tax basis.
As a small business owner, say I start my own LLC, is there a minimum amount of taxes for the first few years?
So LLC, the other thing you could do is as a single member, you could form an LLC. have the legal protection around an LLC, and have that flow through to you on your individual return. And so you can have, unlike a partnership where you had to have two people, an LLC you can have one person, have some legal protections around the legal shell, but have everything flow through to you and taxed on your individual return. So it's similar to a sole proprietorship, but you could have it in a business form.
So say the Texas fee, I want the Texas to pass through. I don't have to pay any taxes for the LLC itself.
That's right.
I just need to pay for whatever distribution I pay back.
The income that comes out.
The net
And it's not based on how much they give you in cash. Remember, one of the things that Robert said, which is important, is if you're in an S Corp, if you're in a partnership, if you're an LLC taxed as a partnership, and you get income, that entity earns income, regardless of whether or not there's cash distributed, you do have to pay tax on your individual return. So most agreements, one of the things you'll want to think about if you form a partnership and you make money is, okay, we need to give money to our investors or our partners quarterly to pay their tax payments. And usually that's written into the agreements that says, okay, on a quarterly basis in April, June, September, and December, we're going to make distributions so that our partners can pay their tax.
I feel like the crux of your question is why would anybody be a sole proprietor when they can just very simply be an LLC? And just from the, I mean, there's no difference in taxation. As a sole proprietor, you're paying individual taxes. As a single member LLC, you're paying individual taxes. So what's the true benefit there? As an LLC, you get some legal protections, such as the same corporate level protection. So if I were going to start a business and I just wanted to be myself, I can't fathom why I would ever do just a sole proprietorship. I would always do an LLC because the administrative burden to form one is very cost effective.
Oh, thank you.
Yeah. Who has not asked a question tonight? All right, so we got one here, one here.
What type of organization would a non-for-profit usually be?
It would be a not-for-profit organization, which would generally file Form 990. And generally, so not-for-profits, as a general rule of thumb, don't pay any tax at all, as long as what they're doing is along the line of their tax-exempt mission. To the extent they deviate from that, that could be considered unrelated business taxable income, and that would be subject to a tax. So if you guys are interested, you guys can go to guidestar.org. You have to put in your email address, put in some information. So subscription is free. You can actually pull up George Washington University's Form 990. You can find out what the president of the university makes. You can find out how much revenue they make. You can find out, it's all public domain. You can find out about any charity, Red Cross, I mean, anything. Go to guidestar.org.
Actually, that kind of sparked another question. But, I mean, I guess with B Corp, because, I mean, I do religious, well, the first thing was when you were talking about subject to taxing and other things, like, you know, as far as, like, if it's public speaking or performing or anything like that, would it go into that? The question when you mentioned the nonprofits, because I think most of them don't really, you know, go through, like, a bingo or whatever the case is. I mean, do they just, are they generally evasive, you know, or whatever the case is?
No. He was using that as an example. There's ways of raising money that would not be subject to tax. What it's really getting at is, let's say you have a charitable purpose and it's you know, to have a church or whatever, and then you have a side business that is, you know, I don't know, developing software, I don't know, completely unrelated
from your mission.
To your mission.
Right.
That income stream is subject to corporate level tax. But if what you're doing is raising money in the normal course of your charitable organization and using it for your charitable organization, that in and of itself is probably not going to be subject to tax.
Bingo is probably a bad example.
Okay. Well, I mean, I guess my other thing, which, I mean, I'll still research the B Corp thing. I know a lot of things, I mean, especially doing religious work or what have you. Like, some people may be like, say, a record company, which would be for profit, or a lot of people, like, they may do the charitable work, but they may be a speaker, which that can be lucrative, or they sell products and all that. Is it just generally all under the nonprofit umbrella by those being donations? Because I know doing stuff for my fraternity, even though they're going to want the money, they're like, the donation for the ticket is $100, but I'm just asking those, like, how that would really go. Because I mean, there are a lot of pastors who speak and make a substantial amount of money on the speaking circuit, or they have books galore. But like would that go more towards the B? But you said with B, there's not really like 1,000 of them, but a lot of them have that hybrid thing.
So if you have a pastor who's speaking and getting paid for it, that's generally taxable income to them. They're performing a service to them personally.
Writing a book, they're going to get income from the book sales.
Yeah. So the church is a tax-exempt entity. Yeah. So when you donate money to the church in its mission of religious organization is not going to pay tax. But the pastor itself, when he goes out and writes a book or speaks and gets compensated for it, that's going to be taxable income to the individual.
So that's just individual sole proprietor.
Yeah,
that's right.
We have time for one more question.
Anybody not ask the question?
Right here.
Wants to ask the question. Okay.
For a company that wants to expand quickly, what is the best form of organization in order to reinvest most of your capital, if not all of it, back into the company? Like you said, there were like tax disadvantages for the partnership. You still have to pay taxes on any kind of revenue or any kind of profit that comes in, regardless of whether you invest it.
Assuming you're making profits.
Yeah,
so
keep
even a lot of startups, again, a lot of the startups that I have are not necessarily profitable. So that might get you over the hurdle right there.
Yeah, but I mean beyond that point.
So if you're saying, assuming you're profitable, your entity is generating income, what is the best format for purposes of what?
For purpose, like say after the 3-year mark, you're making profit probably. And say you have a good product and expand it quickly, what would be the best entity or structure in order to reinvest most of that?
I still think I would probably default early on to an LLC. I think the double layer of tax, maybe it's because I'm a tax person, just offends me.
The LLC is arguably the most flexible.
And it's the most flexible. You can get, if you're making money and you're making profits, you can distribute money to your shareholders or your partners to get them to pay tax. And it gives you flexibility down the road for you can have investors into your LLC, or you can have you can easily convert it to a C corp down the road if you want to go public. And yeah, that's my own personal view.
It works.
So you're saying
LLC?
I think so.
S corp is close behind, but
yeah.
LLC is really easier.
Yeah.
I was going through my graduate tax program, and that was the last question in my partnership classes. They give you a bunch of facts, and the question was very simple: what legal entity would you choose? And there's no right or wrong answer. You apply the facts, and you have to basically determine, you craft your argument what you find is best for you. So it's not a one size fits all.
Gentlemen, thank you very much.